Welcome back to the channel, everyone. Today I want to talk about brokers bribing AMC and GameStop apes into not DRSing their shares, and even offering up to $1,500 not to do so. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, holy crap. Someone on r/superstonk posted about how TD Ameritrade offered them $1,500 to keep their GameStop shares in their account instead of transferring or DRSing them into Fidelity or to ComputerShare. So here you can see somebody recently purchasing some GameStop shares back on the 28th of September and also recently receiving a rebate of $1,500 on the 7th of October. Now, I don't know about you, but $1,500 for a rebate sounds like an awful lot just for referring a friend or opening a free share, for example. Typically, if you refer someone, you might get, say, a few $100s in free shares, or you might get a fixed amount of, say, $50 to $100 per referral. Now, you could also argue this could potentially be a rebate for lending out their GameStop shares, although considering the interest rate to borrow GameStop shares is somewhere between 0 and 2%, you'd have to have an awful lot of shares being lent out to earn $1,500 in rebate fees. For example, if GameStop has a 1% borrow fee and this is a 1-month rebate, then they'd have to be lending out $1.8 million worth of GameStop shares to earn $1,500 in a singular month. There's also what looks like an email chain or an exchange of conversation here as well. Important information about your cash offer. I appreciate the time you took to speak to me about your account. Per our conversation, I've included the details of the TD Ameritrade cash offer that you have agreed to participate in. Again, I want to thank you for taking the time to speak with me, and I look forward to working with you in the future. I would be more than happy to help you with any questions. Now, it looks like this GameStop ape took his $1,500 rebate and used it to buy 9 more shares of GameStop. Now, I also wanted to talk about this excellent speech. The SEC is taking a hard look at dark markets, except for the darkest of them all, dark pools. On Tuesday, SEC Commissioner Alison Heron-Lee delivered an exceptionally well-researched speech on the rising dangers to the broader US economy from the burgeoning dark private markets for non-publicly traded stocks. She makes many important points. However, there is a far larger and far more dangerous dark market, the dark pools owned by the serially charged mega banks on Wall Street that are trading on a daily basis in darkness, the publicly traded stocks that reside in public pension funds, and the mutual funds that make up the bulk of retirement funds of tens of millions of Americans. According to an April 2021 report from McKinsey & Company, global private equity AUM reached $4.5 trillion in the first half of 2020. That's the dark market that SEC Commissioner Lee is worried about, the non-publicly traded dark market. The publicly traded market in the US stood at $54.768 trillion as of June 30th, according to data from the Federal Reserve. That's 12 times the size of the global private equity market. Which one do you think represents a greater threat to financial stability in the US? The SEC has admitted to being understaffed and underfunded. Shouldn't it focus its limited resources on the biggest or bigger threats? It's not that the SEC hasn't been put on notice for a long time now that what's going on in Wall Street's dark pools is nefarious and highly likely illegal. It then goes on to talk about high-frequency trading firms, and it says that all of that turnover was having a real-world impact on stocks. At the end of World War II, the average holding period for a stock for institutions was 4 years. By 2000, it was only 8 months. By 2008, 2 months. And by 2011, it was 22 seconds. One founder of a prominent high-frequency trading firm once claimed his firm's average holding period was a mere 11 seconds. Dark pools are even darker today than they were in 2012. But one thing we know for certain from the stale, aggregated data that's released by FINRA is that mega Wall Street banks like Goldman Sachs, Citigroup, Bank of America Merrill Lynch and JP Chase are trading their own publicly traded bank stocks in their own dark pools in thousands of transactions each and every week. Are these banks using depositors' money to buy back their stocks in their own dark pools? Nobody knows. Are they manipulating their share prices by trading in a cartel in these dark pools? Nobody knows. Why aren't these banks allowing these trades to be exposed to the disinfecting sunlight of a regular stock exchange? Nobody knows. Now currently most people don't have a lot of confidence in the stock market. It seems like all of these big institutions and market makers get all of these exemptions, there's a lack of reporting, and it basically seems like all of the normal laws and regulations that apply to us don't apply to them. But when investing in cryptocurrency like Bitcoin, Ethereum, and many others, it's much more of an even playing field. I personally use BlockFi to invest in cryptocurrency. Not only can you just buy some Bitcoin, but you can also earn interest on your deposits up to 8.25% per year. BlockFi also offer a rewards credit card, where you can earn an introductory rate of 3.5% cashback on your purchases paid in crypto. There's also no annual fees, but unfortunately the credit card's only available in the US at the moment and not in the UK. But when you've generated a large profit on your investment, instead of having to sell off all of your Bitcoin and potentially missing the next run, you could just take out a crypto-backed loan with BlockFi if you wanted to buy a new car or pay some regular bills, for example. So be sure to sign up to BlockFi using my link down below in the description to get up to $250 of free Bitcoin just for signing up and making your first deposit. And I also wanted to touch on some Ortex data for the AMC shorts. AMC just passed $41, bringing short sellers losses of $375 million since the beginning of the week. This is good news that the shorts are once again increasing their losses and digging an even deeper hole, as it seems AMC has had its inflection point and is now back in that bullish uptrend. And I also wanted to touch on another tweet from the SEC. Today we announced awards of approximately $40 million to two whistleblowers, whose information and assistance contributed to the success of an SEC enforcement action. Over the last few months, it seems like the SEC has been giving away tons and tons of whistleblower awards. Clearly they are taking some things seriously in terms of market regulation. However, going forward, I'd like to see some massive awards to people exposing proper market manipulation in stocks like AMC and GameStop. Also, Evergrande's $1.7 billion, yes, $1.7 billion US dollar Hong Kong headquarters sale flops as the buyer withdraws. Evergrande's been trying to sell their offices out in Hong Kong to raise some money because they obviously don't have any cash to meet their bond repayments. They were trying to sell their office, but the sale just flopped. Another Chinese property company just pulled out of a proposed $1.7 billion deal to buy Evergrande's headquarters building over worries about the developer's dire financial situation. The collapse of the talks for the landmark building sale is another setback for cash-strapped Evergrande, which has been scrambling to divest some assets to repay creditors knocking on its doors. With more than $300 billion in liabilities, it's already missed 3 rounds of interest payments on its international bonds. Although that Chinese property company just faltered after the board opposed the move over worries that Evergrande's unresolved indebtedness would create potential complications in completing the transaction smoothly. Although, funnily enough, Evergrande financed the purchase of those offices with more bonds that it issued to get enough cash to buy the offices. The price paid was around $1.6 billion US dollars in 2015, or 12.5 billion Hong Kong dollars, and they used around 10 billion Hong Kong dollars in bonds to finance that transaction. It seems like Evergrande is struggling to sell pretty much anything that it still owns. I guess customers are just a bit weary of buying anything from Evergrande in case in the future they lose it or have to give it back. On top of this, it now seems like Chinese financial institutions are also in trouble. China's central bank, PBoC, issues rules on systematically important banks and lists 19 systematically important banks, including 6 state-owned commercial banks, 9 joint stock commercial banks, and 4 city commercial banks as well. PBoC says that systematically important banks should meet additional capital requirements and additional leverage ratio requirements as well. This sounds very similar to the requirements that the Chinese government implemented against Chinese property firms. We now know that those property firms can't meet basically any of these requirements, and that's why they can't borrow any more cash, and that's why they're going to default on their existing loans. Now, the worrying thing is that I think many of these banks also won't meet these leverage ratio requirements and will eventually default on their debts as well. And finally, the Bank of England warns loan defaults are expected to rise. The Bank of England has warned on rising defaults on household and business loans, with expectations of an increase by the end of November. Therefore, clearly the Bank of England expect the market to crash by the end of November, and that crash is going to impact consumers and businesses as well, and they're going to struggle to repay their loans. In its latest credit conditions survey for the third quarter of this year, it said that net percentage balance for changes in default rates decreased over the period. The poll of lenders also found that more households are forecast to have defaulted on mortgages and other loans, including credit cards, in the next few months. The prospect of higher interest rates, the end of the furlough scheme, which is like unemployment benefits, a cut to universal credit, and rising inflation could contribute to the potential increase in default rates among consumers. There is a potential red flag in the fact that demand for unsecured lending in the form of credit cards and loans increased in the third quarter, and that lenders expect it to increase further in the next quarter as well. On the one hand, it could be a sign of confidence, and on the other hand, it could be a sign of finances being stretched and people increasingly relying on loans and plastic to stay afloat. Guys, be sure to let me know down in the comments below what you think about brokers like TD Ameritrade basically bribing their customers not to transfer or DRS their shares. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!